Let me ask you something that most people never actually stop to think about. If you had $100,000 right now, would you put it in real estate or would you put it in the stock market? Most people have an opinion on this. A strong one, actually. Your friend who bought a rental property 3 years ago will tell you real estate is the only real wealth. Your coworker who has been investing since 2018 will show you their Robinhood app like it's evidence of something. Everyone has a side. But here's what almost nobody tells you, and this is the part that actually matters. The math behind both of these things is not what you think it is, not even close. And I don't mean that in a gotcha way. I mean it in a quiet, almost uncomfortable way. Because when you actually run the numbers, certain assumptions you've had for years start to look a little shaky, like the idea that real estate always beats stocks, or that stocks are just gambling with extra steps, or the one I hear most often, that owning property is the safe choice. Safe. That word is doing a lot of work there. Here's what this video is actually about, not which one is better in some abstract sense, but what the math really shows, what the psychology behind each choice actually looks like, and why most people, even smart people, end up making the wrong decision, not because they didn't have information, but because they had the wrong frame. Stick with me on this, because the answer is a little surprising. Before we get into any numbers, I want to talk about something that rarely gets mentioned in these comparisons. The reason people choose real estate or stocks is almost never purely financial. Think about that for a second. When someone buys a rental property, there's this feeling that comes with it. You can drive past it, you can touch the walls, you can show someone and say, "That's mine." There's a psychological weight to physical ownership that is genuinely powerful. It feels real in a way that a brokerage account just doesn't. And that feeling, it's not irrational. It's deeply human. But here's the thing. That same feeling, that comfort, that sense of control, it quietly shapes the financial decisions people make around the asset, and not always in their favor. Most people who own rental property will tell you it's performing well. Ask them the actual return. Most of them don't know, not precisely. They know the rent comes in. They know the property has gone up. But when you factor in the mortgage interest, the maintenance, the vacancy months, the property taxes, the landlord insurance, the time they personally spent managing it, the actual number gets a lot fuzzier. And this isn't me criticizing real estate. This is just how human beings relate to things they can see and touch. We assign them more value. We remember the wins more than the costs. It's called the endowment effect, and it affects almost every property owner in ways they don't realize. Now flip it. Go to the stock market side. The psychology there is completely different, and honestly, almost opposite. Stocks feel abstract. A share of an index fund doesn't feel like anything. You can't drive past it. You can't show your parents. And because it's just numbers on a screen, people treat it like numbers on a screen. They check it when the market drops. They panic. They sell at exactly the wrong moment. They feel like they're gambling even when they're not. So here's what's actually happening in most of these comparisons. It's not really real estate versus stocks. It's two completely different psychological experiences that happen to both involve money. One feels safe but has hidden costs most people never fully account for. The other feels risky but has a long-term track record that is genuinely hard to argue with. If, and this is a big if, you can manage the emotional side of it. Most people can't, and that's not a criticism. That's just honest. Here's the quiet truth. The best investment is almost always the one you can stay in long enough for compounding to do its job. And your ability to stay in something is not just about math. It's about temperament, about what kind of discomfort you can sit with. Real estate investors sit with broken boilers and difficult tenants and months where the numbers are tight. Stock investors sit with watching their portfolio drop 30% and not touching it. Both of those require a very specific kind of patience. Neither one is easy. They're just hard in different ways. And once you understand that, the comparison starts to look completely different. Okay, let's actually get into the math. And I want to do this carefully, because this is where most videos either oversimplify or quietly manipulate you with cherry-picked numbers. Let's start with real estate. Say you buy a property for $300,000. You put 20% down, so that's $60,000 out of pocket. You take a mortgage on the remaining $240,000. The property rents for $1,800 a month. On paper, that looks pretty good. $1,000 to $1,800 coming in every month. Passive income, the dream. But let's slow down here. Your mortgage payment on that $240,000 at a reasonable interest rate, Let's say around 7%, which is not unrealistic right now. That's roughly $1,600 a month just in principal and interest. Then add property taxes, insurance, maintenance, which financial planners typically estimate at about 1% of property value per year, so $3,000 annually, or $250 a month. Now you're already at roughly $850 in monthly costs before you've even accounted for vacancy, and vacancy is real. Most rental properties sit empty for at least a few weeks per year between tenants, sometimes longer. So your actual average monthly income, when you smooth it out over a year, is probably closer to $1,750. Maybe $1,700 if you're lucky. Which means in the early years, you are essentially breaking even, or slightly underwater. Now, the real estate investor will say, yes, but the property is appreciating. And that's true. Historically, U.S. real estate has appreciated at roughly 3 to 4% per year on average. In some markets more, in some less. So that $300,000 property might be worth $360,000 in 5 years. That's real wealth creation. But here's what people miss. That appreciation is on the full $300,000. But you only put in $60,000, so your actual return on invested capital is much higher than 3 to 4%. This is leverage, and it is genuinely one of the most powerful advantages real estate has. The bank essentially amplifies your gains. Over a 10-year period, with moderate appreciation and a property that cash flows even slightly positive, a well-chosen real estate investment can produce total returns, including equity buildup from mortgage paydown, appreciation, and cash flow, somewhere in the range of 8 to 12% annually on your initial investment. Sometimes more, sometimes less. It depends heavily on location, timing, and how well you manage it. That sounds solid, and it is. But now let's look at the other side. The S&P 500, which is just the 500 largest publicly traded companies in the United States, has returned an average of roughly 10% per year over the last 50 years. After inflation, that's closer to 7%. But that 10% nominal figure is the one most people use for comparison, so let's stick with it. You take that same $60,000 and instead of using it as a down payment, you put it into a low-cost index fund. You don't touch it. You don't check it every day. You just let it sit. At 10% annually, compounding, after 10 years, that $60,000 becomes roughly $155,000. After 20 years, it's around $404,000. After 30 years, it's over $1 million from $60,000 without doing anything. Now that's also a real number, and it deserves the same respect as the real estate math. But here's where it gets interesting, and this is the part most comparison videos just gloss over completely. These two numbers are not measuring the same thing. The real estate number includes leverage. The stock market number doesn't, at least not in this basic version. If you wanted to apply the same leverage logic to stocks, borrowing money to invest, the math gets a lot more complicated and a lot more volatile. Most financial advisors would tell you not to do that, and they'd be right. So what you're really comparing is a levered real estate investment against an unlevered stock investment, and that's not quite a fair fight. If you put that same $60,000 into stocks and also invested the remaining $240,000 that the bank was covering in real estate, well, you don't have $240,000 lying around. That's the whole point of the mortgage. The bank gave you access to capital you didn't have. Stocks don't offer you that by default, and that distinction, access to leverage through a mortgage, is genuinely one of real estate's most underappreciated advantages. But there's a flip side, and it's a big one. Leverage amplifies gains. It also amplifies losses. If that $300,000 property drops in value by 20%, you've lost $60,000, which is your entire down payment. Gone. Your net equity is zero. That doesn't happen with an index fund unless the entire market collapses, which has happened, but historically it's always recovered. So real estate gives you the upside of leverage with a physical asset that tends to be more stable than individual stocks. But it's not without risk. It just feels safer because you can see it. And that feeling again, that's the psychology creeping back in. So we've established that both can work. Both have real, legitimate math behind them. But here's where I want to slow down and say something that most of these comparisons never actually get to. The question isn't really which one returns more on paper. The question is, which one returns more for you, given your life, given your time, given what you're actually willing to do and not do over the next 20 years. And that reframe changes everything. Let me give you a concrete example of something most people don't think about when they romanticize rental property income. Your tenant calls at 11 p.m. on a Tuesday. The heating isn't working. It's January. You now have a legal obligation, in most places, to fix that within 24 hours. So you're calling contractors at midnight, or you're driving over there yourself, or you're paying emergency rates to someone who knows you have no choice. That's a real cost, not just in money. In time, in stress, in the kind of low-grade mental weight that comes from being responsible for something that other people live inside of. Now multiply that by however many units you own. Multiply it by 10 years. Some people genuinely don't mind this. Some people are wired for it. They like the tangibility, they like the problem solving, they like the relationship with the asset. Those people tend to do extremely well in real estate because they're engaged and attentive in ways that actually improve returns. But a lot of people buy a rental property because they saw someone on the internet talk about passive income and discover that it is not passive, not even a little, not at first, and often not ever. Unless you hire a property manager, which typically costs 8 to 12% of your monthly rent, which quietly eats into those already thin cash flow margins we talked about earlier. Here's the contrast that hits differently when you actually sit with it. An index fund has never called you at 11 p.m. It has never had a leaking roof. It has never had a tenant who stopped paying rent and took 4 months and a legal process to remove. It just sits there, quietly compounding, completely indifferent to whether you check on it or not. That's not nothing. That's actually worth something real when you calculate the total cost of ownership, including your time, your attention, your stress levels, not just your dollars. Now here's the part that I think is the real answer, and it's not the one either camp wants to hear. The data, when you look at it honestly, suggests that over long periods of time, 20, 30 years, a well-diversified stock portfolio and a well-managed real estate portfolio produce surprisingly similar total returns, not identical, but in the same neighborhood, somewhere between 8 and 12% annually, depending on conditions, timing, and execution. What actually separates wealthy people who used real estate from wealthy people who use stocks is not the vehicle. It's the consistency. It's the fact that they chose something, stayed with it, kept adding to it, and didn't panic when things got hard. That's it. That's the whole secret. And I know that sounds almost too simple, but the data keeps pointing back to this same thing over and over again. The investors who win are not the ones who pick the perfect asset. They're the ones who didn't abandon their asset when it got uncomfortable. Real estate investors who sold during 2008 locked in catastrophic losses. Stock investors who sold in March 2020 missed one of the fastest recoveries in market history. In both cases, the asset recovered. The people who sold didn't. And here's the emotional truth underneath all of this, the thing that's actually hard to say out loud. Most of us are not making purely financial decisions when we choose between real estate and stocks. We're making identity decisions. The rental property feels like something a real investor does, something your parents understand, something with weight and permanence. The stock market feels abstract, almost theoretical, even when the math is just as solid. And that gap between what feels real and what actually builds wealth, that gap is where most people lose decades of compounding. Not to bad investments, to the wrong feeling about what an investment should look like. Sit with that for a second. Because if you've ever felt vaguely guilty about not owning property, or vaguely anxious about putting money into something you can't touch, those feelings are not random. They were shaped by decades of cultural messaging, by what your family said about wealth, by what feels respectable versus what feels like gambling. And those feelings are costing people real money, real time, real options. The math doesn't care what feels respectable. The math just compounds quietly in the background, waiting for you to get out of your own way. So where does all of this leave us? If you came into this video expecting a clean answer, real estate wins or stocks win, here's the number, case closed. I understand if that's a little frustrating, but I think you already knew, somewhere, that it was never going to be that simple. Otherwise, you wouldn't still be watching. Here's what I actually think, after going through all of this honestly. If you have access to a good property in a market with real demand and you have the temperament to manage it or the margin to pay someone else to, real estate is a genuinely powerful wealth builder. The leverage alone makes it worth serious consideration, especially earlier in life when time and compounding are both on your side. But if you don't have that, if the properties in your area are overpriced relative to rent, if you don't have the time or the appetite for active management, if the down payment would drain your entire liquid savings and leave you with no cushion, then forcing yourself into real estate because it feels like the real investor move might be one of the more expensive mistakes you make. Because a consistent, boring, automatic investment into a low-cost index fund, done for 25 or 30 years without interruption, will make most people significantly wealthier than a stressed, over-leveraged, poorly timed real estate purchase that they eventually sell at the wrong moment because life got complicated. Boring wins. Consistency wins. Staying in the game wins. And here's the thing that I keep coming back to. The thing that feels most true when I look at how actual wealth gets built over actual lifetimes. The people who end up financially free are almost never the ones who found the perfect asset. They're the ones who found something they could understand deeply enough to trust, and then trusted it long enough for it to work. That's the whole game. And it's deceptively hard. Not because the math is complicated, the math is actually pretty simple. It's hard because life keeps giving you reasons to stop. The market drops and your brain says, get out. The property has a bad year and you think maybe this was a mistake. You read an article that says everything is about to collapse and suddenly all your confidence evaporates. And in those moments, the only thing that separates the people who build real wealth from the people who stay stuck is whether they can hold on through the discomfort long enough for the numbers to do what numbers do when you leave them alone. Time, patience, staying in. That's not a sexy answer. It doesn't make for a great thumbnail. But it's what the data keeps showing, quietly, year after year, if you're willing to look at it without needing it to be more complicated than it is. So if you take one thing from this, just one, let it be this. Stop asking which investment is better. Start asking which investment you will actually stick with, which one fits your life, your temperament, your timeline, which one you can add to steadily, hold through volatility, and not abandon the moment it stops feeling good. Because the best investment in the world, abandoned at the wrong moment, underperforms a mediocre investment held with patience and conviction for 30 years. Every single time. That's not an opinion. That's arithmetic. Most people will hear this and still miss it. They'll go back to arguing about real estate versus stocks, picking sides, looking for the shortcut that confirms what they already wanted to believe. But a few will understand exactly what to do next. And if you're in that second group, if something in this video shifted something for you, even slightly, then you already know this kind of thinking is what separates people who talk about wealth from people who quietly build it. If you want more of this, the kind of financial thinking that actually holds up when you look at it closely, subscribing takes 2 seconds, and the next video might be the one that changes how you think about money for good.